All right, so we're here. Quick little rapid setup as I was coming in, as you were coming in. So I think you were early and I was late. So
yeah, I'll be early and you be late.
Combined, it kind of worked out, but we got this all set up.
Yeah, we're good.
Cool. Thanks for joining us, man.
No worries.
So what's, you kind of went through this transition not too long ago. When did we first meet? Was that 2 years ago? I don't know why COVID's thrown everything off for me. I don't know what years are anymore.
Yeah, so I joined Rockstar at the end of 2019.
Okay.
I think I only went to one live event.
But you were still working in your you were doing your previous life at that time.
In the corporate days.
Yeah. And that was, and just for everyone, that was, it was some sort of software.
Yeah, so I'm a professional engineer by trade. Systems engineering is what my degree's in.
Okay.
I worked in the corporate world for about 20 years, yeah.
So you're very anal.
Yeah,
like
numbers guy.
You like everything.
Order, all that good stuff. Right?
So the pandemonium that, when you're walking in here and people are getting ready right before you come, you're just like, what's wrong with these guys?
No, it's all good. My wife is very extroverted, so she balances me out a lot. Yeah.
So, okay. But then you decided to make a transition. So you were investing in residential at that time?
Yeah. So I'll kind of give you my history there. So, and maybe I'll just start with now. And
yeah, sure.
Yeah. So I own and manage a company called Focus Developments. So it's a real estate holdings company, and we specialize in acquiring and managing industrial real estate here in Ontario. But I've been investing personally in real estate for about 20 years. So I've done everything from, duplex conversions to like student rentals, multi-unit properties, and then now obviously in the commercial side. But prior to starting Focus Developments, I worked in the corporate world for about 20 years.
Yeah, and Focus was just recently. So when was that? That was, was it a couple years ago? Longer?
2 years ago, yeah.
Oh, it was 2 years ago.
2 years ago, yeah.
Okay. Mm-hmm. And then what made you, you decided, you corporate world's in the past, and then that's when you started getting into industrial, because if I remember correctly, you weren't doing industrial beforehand.
No, when I first linked up with you guys, it was to continue to build my residential portfolio, and when I decided to go out on my own, basically I left the corporate world a couple of years ago. I needed something that was going to scale a lot better. I needed something that was going to be something that I could leverage, which was going to take advantage of the skills and the background that I had as an engineer. Mm-hmm. Some of the corporate stuff I've done, and working in commercial real estate previously in my corporate days, and also something, again, that I think is a bit of a niche that I wanted to take advantage of. And so those all came together to point me in the direction of industrial real estate being our niche.
Why industrial? Because industrial is like, it's a different world.
Yeah.
Right? I mean, in some ways I'm always a big believer there's good and bad to everything, right?
Yeah.
So there's a good side, there is a downside too. And there's a learning curve involved in it. So if you're leaving this corporate side of things and then, figuring out what you're going to do, you're kind of jumping into not really the unknown, like it's still real estate. So some of the same principles apply and stuff like that, right. But it's outside of a comfort zone because it's something you've never done before. For sure.
Yeah. So good question, because I even in real estate circles, I talk about industrial real estate and people kind of look at me like I've got two heads or something, and it's a different animal for sure. And it's different, and it's got its own sort of unique characteristics when you're comparing it to residential real estate or really any other asset class in the real estate space for that matter. So one of the things I think that you can look at industrial real estate for in terms of having its own unique characteristics is because it's a commercial asset class within real estate, it's going to have a different setup in terms of how you manage your tenants, the lease structure, the types of tenants you have, just some of the amenities and just different things that the tenants are looking for. But there's a lot of differences when you're talking about an industrial unit or another commercial unit for that matter, that a business is leasing out or renting versus in the residential side, someone's home, right? So we've all had those kind of, horror stories of dealing with evictions and things like that. And so, one of the main things is that you're dealing with business tenants, right? And so there's a variety of different things that, I can kind of get into as we go here.
But your logic when you were doing that, like I understand that, you know what I mean? But is that what came into the decision? You're like, hey, look, I don't want to deal with tenants on the residential side, so I want to go down this route.
Yeah, good question. So it was part of it for sure.
Okay.
I would say so it's a combination of things, as I was just saying. The main thing is I needed something that was going to scale. So if I wanted to keep doing, single family homes or student rentals and do that full time, people do wholesaling. It's you need to do a lot of those, right? So commercial real estate and industrial real estate will scale a lot better just because of the size of the properties you're dealing with, right? You're typically, we focus on the mid-market. So we're talking $2 to $10 million properties. So if you're doing a couple of those deals every year, compare that to having to do
2 to 10
of the smaller residential stuff, right? So you're going to have to do a lot of those. There's just a lot more churn. So that was one of the factors for sure. The second was, again, just the lease structure and the types of tenants that you're dealing with. I was really getting sick of the tenants and toilets on the residential side, and things could have been going well with one of my residential properties, and all of a sudden a furnace breaks or tenant damages something, and then boom, there goes your cash flow for that month. And so when you're dealing specifically in industrial properties, we're setting up something called a triple net lease, right? So that is a truly pass-through net lease for the benefit of the landlord. And so what that allows you to do is have just a lot more control about and predictability in terms of what your cash flow is actually going to be, right? Because you're charging base rent, and then you're charging an additional rent for common area maintenance, for property taxes, for insurance, for literally everything else that's going to come up as an expense on that property.
Yeah.
So you're not like beholden to what might happen with the tenant at the property, right? So,
so what kind of numbers did you use for turnover during vacancies? Because that's the flip side to that is like, okay, that sounds great. Yeah. However, when in a lot of industrial spaces, when a tenant leaves, in residential you can fill it in 2 weeks,
right?
Whereas in industrial, it's very uncommon to be able to turn over a property so quickly. Yeah. Sometimes it's months, depending on the types of properties, where they are, and all sorts of things. So it's months and months. So you're carrying the property then for that period of time,
right?
So what in your calculations? Because I know there was calculations as an engineer. I know the calculations existed.
Yeah.
You're not using a 2% vacancy rate, So like, where does that how does that fall into place?
Right. So I'm typically basing my vacancy rate, factor in my underwriting based on the availability rate in the particular market I'm looking at. Okay. So if you look at those rates, nationally they're between 4% and 5%, and here in Ontario they can be much lower than that depending on the market. So the markets that we focus on secondary markets. So we're outside of the GTA. And typically, we're in southwestern Ontario. We're up in Sudbury. We're out in Chatham. We're looking for secondary markets that are about 100,000 population and to 250.
And why that? Is there's less demand right now, or just a little bit less demand, or
there's just more value there, right? Okay. So if you look at the cost per square foot of industrial real estate, it's going to be generally between $200 and $400 a square foot. 200 would be the much smaller markets. 400 would be kind of, a GTA type of situation.
So that's around the GTA. That's not Toronto.
That would be, the Toronto market, right? Those are the stats that we're getting out of that. Yeah. So, it would include Mississauga and places like that and Markham. But if you look at the lease rates, that you're going to be getting in those same markets, they're going to go from between all-in lease rates are going to be, $18 to $24 a square foot. So if you look at that spread per square foot, it doubles going from the smallest to the biggest. But in the lease rates,
cost, but
it's only going up about 30%. Yeah. So there's lots of value in those smaller markets, right? Because you're getting a pretty healthy lease rate and you're not paying comparatively a whole lot for it. So there's good opportunities for cash flow in those secondary markets. So that was one of the things I looked at specifically is the lease rate there and the value that you can squeeze out of these properties.
Well, we've seen the same thing on the residential side consistently, like for years and years. And, so why do you think that is on the industrial side? Like I know there's so it's a secondary market, so there's a little bit higher risk. So I guess that's where it comes down to. Is there anything else that I'm missing with that? Because sometimes I look at that and I'm like, it just seems that there's got to be a number of people that would look at that sector and be like, hey, it's pretty simple math, like you just did there, and in that gap would close a little bit more,
right?
But I guess. like historically, I feel there was more risk in those markets than there has been over the last 10 to 20 years, call it.
Sure.
Right? So maybe a while ago it was a little bit different, but with the population base and the kind of the infrastructure that's been put in place since then, it's not really the same. And that's why I've always wondered, like, I'm not complaining.
Sure.
The opportunity's there. I'm just wondering if there's anything else that I'm missing that you've seen.
Well, so the market, I will say, it's very fragmented, right? So in the segment of the market that we play in, so again, sort of mid-market, not too big for the really small guys, but too small for the big institutional investors. In that mid-market range, there's just a lot of fragmentation. You do have some owner-operators who've got a $5 million warehouse that they're running, but it's all over the place. So there isn't a whole lot of, I guess, uniformity there, where you've got these big institutional investors coming in and sweeping up and making markets unto themselves. And so I just think that's a factor, but also, just going back to the price of land, like the price of land in some of these secondary markets in these industrial parks is actually not that valuable when you compare it to the GTA. So it's just a cost thing, Yeah.
And then, so what have you seen? Your properties specifically, do you have high, like how high are used for warehousing, I guess is what I'm asking?
Yeah, we've got a variety of tenants, but yeah, they're all, our smallest tenant would be about 2,000 square foot unit, and then the biggest one's about 9,000.
Okay. Because I know what I've seen around here. I'm talking specifically in Mississauga. I think all three stories I know of in Mississauga is I know that the lease rates have just jumped dramatically, specifically for industrial areas where there is ceiling height, because they're being used for warehouse. So like these were businesses that didn't need the ceiling height before.
Yeah.
The one that's coming to mind, I know the other ones I just forget, but the one that's coming to mind that I know best is a gym.
Yeah.
So it was a gym that was in one of these areas. They didn't need the ceiling height.
Right.
And then when their lease renewal came up, they basically were going to have to close their business. They've ended up kind of restructuring a bit, went into a much smaller space because the lease just jumped. So that's what I've heard is just the demand for these types of properties with good ceiling height for a lot of it has to do, it's not just warehousing, right? Yeah. But a lot of it has to do with warehousing. Have you seen the same in those other markets that you're in?
Yeah, absolutely. So any modern build, so we just completed a building out in Chatham last year, and the ceiling height was 22 feet clear, which in today's world is actually pretty low ceiling height for modern industrial buildings. You look at the Amazons of the world, those big bomber, warehouse buildings, and they're going 36 foot at least. And really because they have to have that density, and they've got very sophisticated racking systems and robots and all kinds of stuff going on in there. The tenants that we lease to... I got to stop you for a second. Have you been to one of those Amazon distribution centers? I haven't had the tour, no, but I've seen the videos and things like that.
I don't think they do them anymore. I signed up, it was this time last year, it was just over a year ago, I signed up and I was supposed to go, and then I got canceled.
Yeah.
And I haven't been able to rebook the one in Brampton, and I've checked periodically. I haven't checked maybe the last couple of months, so maybe they've opened it up again. That Amazon tour in person was awesome.
Yeah.
Like the second time I booked it, I wanted to take my family because I'm like, kids, you got to see this. Like, so
it's unreal.
Yeah.
It's unreal.
So when you talk about sophisticated, that's their whole distribution center system. That's one thing, but even just the racking with some of these other companies, just the way they're doing the racking and the kind of inventory management stuff.
Yeah.
It's a whole different level than you would think when you're not involved in the process, right?
Yeah. It's really amazing. And so, those buildings are 100 to, 500,000 square feet, they're massive buildings.
But like those big Amazon buildings, Amazon doesn't own them. They're leasing them, aren't they?
They own some.
Oh, do they own some of the ones even here?
I'm not sure, how it's sort of spread out, but I know in certain parts of the US, they'll work with, property managers and just, industrial owners, and they'll say, this is what I need. I want to be in this market. I need 250,000 square feet. And, I need it in 18 months or whatever it is. And so you see markets like Texas where they'll have partners down there and they're building big buildings just because of the speed at which they can do stuff compared to here in Ontario. Just things are going to take a lot longer.
Yeah, I got it. Yeah. I always looked at that. I'm like, why not just buy the thing? Why are these guys leasing anything?
Well, I think it's like a lot of companies. Like if that's not their core specialty,
Yeah, they don't
just
want to
don't want to do it, right?
Yeah,
Because there's
that's
just
fair.
another layer of overhead, and then they got to have a property manager or a property management team on staff to just kind of run things.
I'd imagine they squeeze the lease rates down pretty good too,
Oh
because
my
if you're the landlord, you're happy to have Amazon there, so you'll allow your margins to be squeezed to have them there because you feel pretty certain about them for a long period of time.
To have a AAA tenant like that, I mean, that's like gold.
Yeah.
However, you're right; they got you, and so they will really push hard. But I think the partnerships that I see do well. It's not just one building; it's multiple properties that Amazon is working with these developers on, and so there's a bit of back and forth and give and take on those ones. Yeah, but I mean, if you contrast that to the other side of the complete other side of the spectrum, these small 2,000, 4,000, 5,000 square foot units, which we have a lot of. They are so easy to lease, and you as a landlord are in such an advantageous position because those industrial tenants, those businesses, they need that space, and this is a function of their business. They can't, work from home. They need this space to actually conduct their business. So, you're in a much better position on the smaller side of that spectrum with your business tenants for those smaller units. So that's advantageous as well.
And those the majority of the tenants you're seeing come, they need the ceiling height as well. Like, is it more and more warehouse spacing that you're seeing demand for, or no? They just need it. No, okay.
No. So we focus in on the smaller units, what we call Class B. So these are older vintage buildings. Typically, we do have a building which we just completed brand new last year. But again, it doesn't have these, really, really tall ceiling heights. And so you're catering to a different clientele there. These businesses are typically contractors, tradespeople. We have a restoration company tenant. We have tenants that handle power equipment. And so it's a variety of just small businesses, tradespeople, contractors typically. Although we have one client who's now setting up a trampoline park in one of our units, so that's going to be fun. But typically the ceiling height, 22 foot high, like I said, is really nice, but it's not a must in that segment of the market.
Those trampoline parks, man, those kids' birthday parties,
oh yeah,
those types of places, it's amazing how much revenue those things bring in, I think.
It's unreal. Yeah. I didn't know much about it. And the other thing that really got me was the cost of the equipment. Just putting together these play structures, trampolines, all the different, the ninja courses and things like that. Yeah, sure. Hundreds of thousands of dollars to put these things together. It's pretty wild.
I mean, anytime my kids have gone to one of those, they've absolutely loved it.
Yeah.
And they're miserable afterwards because they're exhausted. But at the time, they like it.
My son, both my sons play soccer, and one of my younger son, his whole soccer team went.
Oh my gosh! I did not want to be in that place.
It was bananas, and unfortunately, two of the kids sprained their ankles. So the coach was livid afterwards. He said, "I didn't approve of that trip." So,
when you get a group of a group of kids, I should say a group of adults. Like, we went to one of the early ones. I think it was the first one around here when it opened in Mississauga years ago. It was like a team event,
right?
And we thought it was kind of going to be fun, and we bounce around. We play some trampoline dodgeball.
Sure. Yeah.
Look, it got pretty serious pretty quick.
Oh, I bet.
And we were dripping. By the time we were done, the entire team was dripping in sweat. Because we were jumping around, drilling this ball. A bunch of Type A personality people. Oh yeah. I'm
not losing. Yeah.
Oh my gosh, it was nuts. It's quite the workout. But with the kids, it's I've seen them before. They're like flying objects.
Oh yeah.
They're like projectiles coming. I'm like, man, someone's going to get injured, bad way. So.
And you don't think about consequences at that age.
You're invincible at that age. I mean, I still think I'm invincible sometimes. I can barely do anything. 45, everything's breaking.
There you go.
Hey, so what about the change though? So, this transition into this world, looking back, I guess you're still going down this path, so it feels like it's probably been a good transition for you.
Yeah, it definitely has, and I don't think I could go back to the corporate world now that I've had a couple years of doing the entrepreneurship thing. Mind you, it was weird, right? Because I'm starting this new path, this new journey in the middle of a pandemic, and things are kind of off kilter or whatever, but. No, it's been a great transition. Honestly, it's again, real estate's something I'm passionate about, and then combining it with sort of the analytical side and a lot of the experience I had in project management, I think it's been a really good combination. We've been fortunate to do a lot of really great projects. We picked up some quality properties, and so on the sort of the numbers side, things have gone really well. So we've been fortunate in that regard. But yeah, it's been a great ride so far.
You keep saying we. Is it you yourself when you started? Do you have a partner?
Yeah, I have staff that. Gotcha.
Yeah. So on that side of it, though, isn't it, going into a corporate space or working, I guess, even during COVID, but, there's people around you, there's people you're talking to on a regular basis. When it's just you behind a computer, starting this thing out, there's an element of loneliness to that.
Yeah.
How did you kind of is that a good thing, bad thing for you? Like, how'd you respond to that? It's different for sure.
It is. So and that's kind of the struggle I think a lot of entrepreneurs have when they're just getting going. Me being more of an introvert and being more of an analytical guy, I don't mind the kind of solo journey. However, I do find I need to have regular meetings with my property managers. I need to have regular meeting with my marketing people, and just kind of make sure that I'm scheduling that time to kind of interact and mix it up. But to answer your question straight up, being more introverted, the kind of doing my own thing and being focused it wasn't that big of a deal for me.
Yeah. So, and you mentioned the property manager. So the management of these properties, how is it structured? So the way you your role here is you're raising capital. Mm-hmm. You find the properties, you do the acquisition.
Correct.
And then ultimately, is the property manager doing the leasing for you? Are you involved in the leasing, or they're just doing the management afterwards? How do you have that set up?
So if it's a brand new tenant, I'm working with a broker.
Okay.
A real estate broker to list the property for lease, to bring in the tenants, to show the place, just like you would do on the residential side. The ongoing management of it, obviously that's the property manager's role. If there's a lease renewal and it's simple, that's something that I can work on. If it's more complicated, we're going to flip it over and have my lawyer have a look at it, things like that.
The management of these types of things are relatively straightforward. I mean, other than clearing parking lots and, roof leaks, I know there's HVAC systems, there's a few things, but other than those kind of big elements, really anything to do with the shell or exterior, there's not much that comes up.
Yeah. And that's the beauty of it too. I mentioned the triple net leases. So, the maintenance of these buildings is pretty straightforward, right? Because these tenants, they're not having very extravagant fit up of their units. If you compare it to a unit like we're in right now, where there's very high end finishes and things like that, that's not typically what's going on in an industrial unit. There'll be some offices, there'll be a washroom, a lunchroom, and then the rest of it, probably 70% of it is going to be warehouse space for storage. And that stuff that's pretty easy to maintain. Yeah.
I remember our dad's old drywall business. He'd walk in, there was a little kind of, entryway with two chairs. There was like an open space, had a couple desks in it. There was two separate offices, one for the estimator, one for him and his partner. And then, the bathroom. And you're right, the rest was the warehouse space. And that space, which is still there, because we have to drive by every time we go to our parents' house, we drive by those office spaces. And to your point, I'm just thinking about this now, to your point about the smaller units being easier to rent out, I don't know how big that was, but there was a number of units it was almost like a little bit of an industrial or commercial little strip mall type thing, like a square that you can kind of just go around with the warehouse space in the middle of it.
Yeah.
And those businesses, they turn over somewhat regularly. I don't know the whole ones, the ones that are visible from the street.
Right.
And it doesn't take too long for, I'm not paying attention too closely, but it doesn't take too long for the new one to pop up, right?
And that's a good point, Nick. So, the sort of standard commercial lease is going to be 5 + 5 or something like that. So a 5-year minimum. However, lease rates have been increasing so quickly. I know a lot of landlords who don't want to sign a 5-year lease with a tenant right now because they want to make sure that they're tracking with what the market is doing. Right?
Really?
Oh yeah. So a lot of, tenants will come in and say, yeah, I want a 5 + 5 at my option if I want to renew, and here we go, and we'll set the rates. And a lot of landlords will say, I'll give you 3 because, if rates keep going up the way they have been in the last couple of years, we're going to be way under market at that, 5-year mark. So that's something that really is something that you got to look out for. So, yeah.
Why do you think rates have gone up so much there? Because for a while with, and I know these are different, they're not office space, and there's more vacancy there and things like that. But even during COVID, people are like, oh, no one's coming into work. No one's going to go back to work. The office space isn't needed. And I know there's a good chunk of warehouse, but if the office space wasn't needed, well, then they have more warehouse, So like what's driving, because it hasn't been normal appreciation rates. So what do you think's driving those rates up this far and fast over the last few years?
Well, I think it's a couple things. One is e-commerce. Again, so for those big buildings, and that trickles down into some of the smaller industrial spaces, e-commerce is a big driver.
Does it trickle down because it pushes other businesses out of those spaces so they can't afford them anymore?
Yeah. Okay. It's just having that impact as well. And even like you will see startup, drop shipping companies and things like that. They'll set up in a 5,000 square foot unit and away they go. So it is having a sort of direct and indirect impact from there. I think the other thing that's driving it too is just the fact that these industrial buildings are essential to what we're doing. If we look back over the last few years and what happened in the pandemic, the only two asset classes that really continued to move upward in terms of how well they were doing is the residential, sort of multi-unit residential, which, everybody needs a home, right? So those things continue to go up. And then the industrial buildings, the industrial properties. And that's because those were two, if you look specifically through the pandemic, those were two asset classes that people needed. They needed a place to live. And those industrial buildings were typically housing essential type services, contractors, restoration companies, e-commerce. So people weren't going to shopping malls, but they still needed things. And so they were ordering them through the internet. And then they were having to touch an industrial building at some point. If you look at everything you order, right, online, it eventually has got to touch an industrial building. So that's the other sort of thing driving it, right? It's this essential property of industrial. Mm-hmm. And I think probably the third thing is the flexibility. So I mentioned the types of tenants we have. We have tenants that have a lot more office and some which really just need a whole warehousing space. So the flexibility of these properties, I think, is really advantageous. And especially for smaller businesses, this is something that can give them some flexibility and help them kind of grow. If they want to take on maybe a 2,000 square foot unit, but they know that they're in a multi-tenant type building and they maybe can expand into the one next to them as they grow as a business, that gives them a lot of options. They don't have to worry about some of these higher cost places that they might get into.
Mm-hmm. I'm just thinking in the past during recessions, those types of buildings, they get hammered pretty good when some of those places, closed, when businesses really get hit. Now, we haven't seen that yet from a business side. The economy's definitely slowed. We were talking about rates sooner, and I don't know, earlier, and I don't know if that's going to occur here. But that's the flip side of that, of when there is a downturn, which now we're in this economy that's so manufactured.
Right.
We've removed all free market force almost, right? Yeah. It's all stimulus. And as soon as the economy starts slowing, everyone's looking at the government. They're like, hey, when are you going to drop rates?
Right.
When are you going to print money? How are you going to get this thing going again? Yeah. There's no up and down. So I'm curious to see, what the impact could or would be this time, because if the way the economy's structured, it just feels like it's less, unless it really goes, unless it really explodes, and then it's deep and then it's hard, on those types of things. I guess that's the flip side of that. Yeah,
for sure. But I think, you look at office buildings and they've been hammered over the last few years.
Yeah.
Because people are working from home, businesses don't need all of that office space. If half your staff wants to work from home, maybe you don't need to be downtown in a high-priced address or location. So, if you look at all of those qualities, that's the opposite of what an industrial building is going to offer you. I mean, these are boring buildings. They're a necessity. They're a function of the business. And you can't work from home, right? You can't send those shipper receiver guys to work from their garage, right?
No, I get that. I guess what I'm trying to figure out is just the economic downturn where those businesses, not that they can't work from home, they don't exist. And then that changes that aspect of things. That's what, and on the office side, it's what's interesting that we saw about the office side is we saw rates here in like these kind of outside of Toronto, the rates were increasing even on the office side.
Yeah.
And I wonder what would have happened to the office market, because the vacancies are still pretty big there.
Yeah.
But the ones in Toronto, there so much of that space is owned by these, like banks, insurance companies, this type of stuff. If it was owned by other types of companies, how would have that reshaped that market? I'm curious to know. I don't know. Like I don't have the answer. I'm curious, because if it was like other companies, they'd be like, well, screw you. I'm done. I'm walking away from this lease. This these 30 floors that I don't need anymore. They've been empty for the last 2 years.
Yeah,
like I'm out of here. Right. So I'm curious. But whereas I don't know what was worked out and what kind of like funding they got, that kind of stuff. So it's just it's weird.
Yeah.
But it's more that question. Like I agree wholeheartedly. Like the businesses here, those are the businesses that
they're pretty recession resistant.
Yeah, but the last, so like if you look at the late 80s, early 90s, when there was a big housing downturn. So look at our dad's business, for example, that drywall business.
Very well, yeah.
They were one of those tenants. They were gone.
Yeah.
A lot of electrician, like a lot of those types of the types of businesses that take up those spaces. For there was a period of time there where there were no jobs in those spaces, and those ones dried up pretty quick.
Right. Well, I think so. I would agree with you. And if we're having a major recession, a lot of businesses across the board are going to get hit. And
totally, yeah.
So, but I think at that, the only thing you can do is just look at, okay, how risky am I getting? What is my risk tolerance with the types of tenants that I'm leasing to, right? So if it's a restoration company, that's one of our tenants, for example. Even in a recession, you're going to need a restoration.
Little bit less than something else that's maybe just a one-off trade or something.
Versus somebody selling, sunflower sunglasses on the internet.
Or something like, and I don't know if they would be a good fit for those types of properties, but if you as a business example, like interior design. Yeah. The restoration company is they're going to have business coming to them for a lot longer than interior design, because if there's a downturn, interior design is one of the things that gets cut earlier than
it's a luxury versus a necessity.
Totally. So,
that tenant profile. Yeah.
It's more, I think the question is more, I just don't know what the hell is going on with the economy.
Yeah.
Do you know what I mean? Because they
both.
Yeah, because they just, the way they do things. So how has that impacted you over the last, I guess your funding is fixed. So the last couple of years of interest rate hikes hasn't really changed much for the properties you already own.
It's been tougher to underwrite properties, right? Because, when interest rates were super low, everything was penciling great and the numbers looked good and you could just throw a dart in the board and hit, I'll buy that one. So it's made, the kind of your hit ratio go down quite a bit, because, you're going to have to sift through probably, 50 or 60 deals before you get to one that goes, okay, yeah, let's have a further look at that one. So you have to be a lot more picky about things. But yeah, the rates, just like any other real estate asset class on the industrial side, rates have an impact, right? And so our cost of financing is going up. We're doing a refinance right now, and it's tough, and lenders are not what they were 2 years ago in terms of the appetite to take on risk.
So prices have leveled, I guess, a little bit. If they come down, come off a little bit of froth, has come off the top a little bit.
A little bit, but here's again the beautiful thing about industrial real estate and commercial real estate from a broader perspective is that as long as you're increasing your net operating income, you're forcing appreciation up, right? So we've been able to increase our lease rates over the last couple of years, which has actually pushed the values of our properties up, right? So it is a bit, when you're comparing it to the residential side, where all you're doing is you're comparing what your neighbor sold it for, and that's going to affect the price of your house, and you're not really valuing those smaller residential properties on NOI. It's a different animal. So, yeah.
Yeah, but that's changed a bit though, because like is one thing that we've always often explained to investors who've wanted to kind of rehab and flip properties is exactly that point. I go, the challenge with it is that it's an emotion driven price when you're trying to kind of get rid of it. But as more people have put in second and third units and stuff, then a lot more of them are selling. Like if you look at student properties as an example, not all those are selling based on the income.
Correct.
Right. And same with the second and third units. So it's a little bit less, I guess, as the investment side has kind of expanded beyond the more typical single unit, single family home rental.
True.
Right? Because then that's where
I'm using that as an example.
Yeah,
Sort of your plain Jane, here's a cookie cutter house on a cookie cutter street, and that's that. Yeah.
Well, it's like the condos, right?
Yeah.
It's like the condos.
That's the extreme. Right?
Yeah, because you can't sell it to an investor because the investor's not going to pay the price. Like right now, not all of them, but many of them aren't going to pay the price that some people will want.
Correct.
Because the numbers just don't make any sense. Right?
Yeah. So, for sure.
Yeah. What about your acquisitions? What are you looking to do on a yearly basis? Like, what's the goal for you to kind of keep growing this thing?
Yeah. So, I mean, I'm not looking to scale this into, $1 billion company or anything like that. Again, one of the reasons I left the corporate world was I just wanted more balance, right? So the business is really catered to the lifestyle I want to build.
Yeah, that's awesome.
And, so that's very intentional in the way I'm doing that. So what that means is I want this to be sustainable and successful and to progress forward. But, our goal is to be doing 2, possibly 3, mid-market deals sort of in that $2 to $10 million range every year, right? And so on the industrial side, one deal could take 6 to 9 months to complete, right? By the time you're done your due diligence, you get through financing, you get your onboarding, your tenants, like all that kind of stuff. So that can really get drawn out. So if we're doing, again, a couple of those, 3 of those every year, that's going to be a success. And we're picking those properties properly, then that's going to be a successful year. And that's really the pace that we want to be going on. And it's sustainable because we'll be adding, maybe 1 or 2 staff in terms of property management every couple of years and kind of go from there. So that's really the sort of level I want to be at. And
you're adding the property managers yourself. So their staff, you're not using a property management company. You're hiring staff yourself in-house to handle that stuff?
No. We're contracting out the property management.
Oh, okay.
Okay. Yeah.
You mentioned lifestyle.
Mm-hmm.
You brought this book over. That you said you really liked Halftime.
Yeah.
And so explain. So this is. It feels like then this transition for you was Halftime.
Yeah, it was, right. If you look back, I've spent 20 years plus doing the corporate gig, and I'm in my late 40s now, and approaching that point in my life where I've got maybe 20 good years left in terms of career that I really want to be dedicating full time to. So it was kind of an appropriate point.
And that's what this is about. So it's about Halftime. Like, hey, the subtitle of this thing, which makes perfect sense, moving from success to significance.
Yeah.
So it means just instead of just going down the standard path. I haven't read it in a while, but it's just the standard path.
Yeah.
It's about deciding what you really want to be doing now.
Yeah, and I think it's a time for reflecting on obviously what's worked and what hasn't worked in the past. And I think a lot of us type A personalities have been go and just full on for a couple decades, right? And we've been raising families, and we've been increasing in our career and doing businesses and things like that. And sometimes it's been at the sacrifice of other things, right? Mm-hmm. It's so I think it's a time to kind of take stock at your midlife, Halftime, and think about what kind of impact you want to make, going forward in that second half. And, obviously, let's be honest, time is not our friend now. We're kind of entering into that second half of life, and, we really got to squeeze the most out of it. So some of the things that you do in the first part of your life, you got to start saying no to now, right? And really kind of prioritize what, if you haven't already, the things that you want to be looking at spending your time on.
How old are your kids?
14 and 13.
Mm-hmm.
Yeah.
So you get to that point where they're getting a little bit older. They're spending more time with their friends.
Yeah.
A little bit less time with mom and dad.
For sure.
Right. And then, and it's
a weird, how old are your,
See, that's why I'm saying my oldest is she'll be 14 this year. So she's 13, and my other daughter turns 10, in a couple weeks.
It's a weird thing.
Yeah.
Yeah. When they become teenagers, and it's just kind of like you drop them off at the mall or something at their friends, and it's,
oh my God, my daughter, they always want to go to the mall. I'm like, please, can you just go anywhere else? Like, just don't go. She's like, okay, we'll go to Starbucks. Oh my God. Those are the two options. So
yeah, it is weird.
But yeah, that's why it kind of, yeah, it's strange because you can see the end. It's the beginning of not the end, but
yeah,
it's the beginning of the time they're going to spend with you are really dropping off a cliff.
Right. Yeah.
And then it kind of causes you to pause and look around a little bit like, for that period of time, you've given a lot to them, and a lot of the time was chewed up by them.
Oh, for sure.
And it's going to now, a lot of that time gets freed up. And I feel like, I'm not really there yet, but I feel like if you can look around and be like, oh man, like I kind of got to be doing something here, or you run the risk of getting into a bit of a rut and feeling like maybe you're lost a little bit. I don't know, because I haven't been through it, right? But I kind of get that.
But you can
sense.
see it there. You can see it on the horizon. Yeah.
Yeah, that's interesting. And then when you were,
and that's not a unique thing. Like I think a lot of people are feeling like that too, right? When they get to this point.
I think it's normal.
Yeah.
Right. From what some people have told me, they're like, yeah, that's like, some very common times for divorce is when people first have children because they think they didn't have a great relationship to begin with. And, and for some magical reason, they thought the kid was going to make it better.
Right.
And I don't know, from my experience, having very young children at home doesn't do much to strengthen a relationship, because everyone's just like, what the heck is going on?
It's
right?
like the stress test we used to talk about, right?
Yeah, it's exactly that. Yeah, that's exactly what it is.
It's the stress test.
So and then it's after the kids kind of leave, because then the parents have to look at each other again and be like, okay, like, do we still kind of we've spent.
Let's start dating again.
Yeah. So it's just weird. It's a weird time because, like I said, with my 9-year-old's not there yet,
right.
But the 13-year-old is very much there. Where I'm just like, holy cow! So she'll be 14 this year. I'm like, in 4 years, if she goes away to school, that's like she's got basically 4.5 years. She might not be at home, which seems to me the most outrageous thing. Like I can't even fathom that.
Yeah.
Right. Where you have one that's even closer. It might be even less years before he or she's gone.
Yeah. Yeah. And I have 2 sons, right. And they're, they starting to flex their independence a little bit and stuff, and you got to have those conversations. But yeah, those are all, like you said, they're all normal kind of feelings to have at this point. But, I think it's healthy. I mean, ultimately, I think it's healthy to kind of go through this and just really kind of think about it, because you want to set yourself up for success in that second half of your life.
Was there an element of that as seeing your kids getting older, maybe showing them that there's some other opportunities, maybe building something that maybe has a little bit more of a not that what you were doing before didn't have more of a lasting impact, but if you're kind of growing an asset base that could be kind of passed on and stuff, it seems like there could be something there. Did any of that come into mind when you were looking at kind of getting into this type of stuff? Yeah,
that's a good question, Nick. It did. And so one of the things, as part of this thinking and reflecting is you start thinking about legacy, right? You start thinking about what you're going to be leaving behind. And again, I don't want to get too morbid about this, but but I mean, it's reality. It's reality. Yeah. And you have to consider it. And so, I think if you can leave something that's not only a financial inheritance, but it's a business, and maybe it's an opportunity for your kids to get involved, either in the management of a portfolio of properties, or maybe there's a way that they can gain some skills and expertise and maybe become leaders and hiring other people. And these are all great things to kind of pass on to your kids, right? So definitely that definitely played a factor in it. And it was something that I, again, was very intentional about. Yeah.
I've been trying to show my kids a little bit more. One is we'll ask more questions about the properties and why do we have these and why are people there and why do they are paying us money, so there's some interest there. And I had this, this magical idea of this current property that was actually just at the one that had me running late today.
Right.
I had to go pick up an extra key fob for the tenant. So as the registered owner, I had to go get it. Right. So I go in. So anyways, it just took me a few extra minutes, but the idea with this property was to have my kids more involved with the management. That's why this one was close to home.
Right.
I had this magical idea. I was like, the numbers on this aren't great, but I'm going to buy it close to home.
Is it a townhouse or a condo?
Yeah, it's a stacked town.
Stacked town.
So I'm like, I'll buy it close to home. Because it's a stacked town, so there's some condo fees. The management's relatively easy. There's not as much to take care of. So my kids at this age will kind of see it. They'll be involved and stuff. My gosh, they like just the first time we took them there, I'm like, hey guys, so this property, and then I'm like, in the future, this property can be there. Maybe they live in it. Maybe it's an investment. They keep it as an investment, like whatever it is. That's the idea. The property's for them,
right?
But they have to kind of be involved in it. My God, first of all, to get them there,
right.
We have to go. And I was like, if you saw my face, I'm like, yeah, we have to go. Be quiet. Get in the truck right now. I can't believe you're being like this.
I'm doing this for you.
Yeah. And you're going to enjoy it, damn it. And then when we're there, my youngest daughter's like, how much longer? And I'm like, I forget what I said. I'm like, look, we're leaving in like 2 minutes.
Yeah,
okay.
Yeah.
1, 2, no word of a lie. She starts counting. And
Oh
I'm
my
like,
God.
I was like, Ava, this is not going to work well. Okay.
Yeah.
Don't do this. So it was, it got really, it was interesting.
Yeah.
It was interesting. So, I mean, I'm still learning how to, I don't care if they ever invest in real estate. Like it's not, they don't have to invest in, I just want them to understand, that there are other ways that aren't regularly shown to them in the typical education system we have. That's all I care about. I'm like, I just want them to understand, here's how the world works. And there's this side of things, of rentals. There's that side of rentals. There's this, just so you have an idea of the landscape, and it broadens your horizon a bit. And then you decide whatever you want to do. If you never do it, great. I don't care. But as long as you know about it.
For sure.
So I'm just curious. So your kids are a little bit older than mine. You've transitioned into this type of stuff. Have you seen, is there any kind of spark of interest? At that age, I know it's tough. At 13 and 14, you care so much about your friends. But
I'll tell you a funny story. So last, November 1st, is Bring Your Kids to Work Day. So I brought my oldest guy, Lucas, the 14-year-old, with me. And so, we were running around, some boring stuff. I had some rent checks I had to deposit and different things, and we visited. Which
are like great, like the income coming to the business is such a great thing. But you're right, it's a boring thing.
It's a boring thing. But I said, here, look at that check, and okay, And so his eyes perked up a little bit, and then we still have some residential properties in the portfolio, so we went and visited some of those and saw the tenants, and picked up a few things, and ran around, and so it was a fun day. But I got to asking Lucas. I said, have you thought about what you want to do and study in university? And he says, no, I don't think I want to go to university. He said, I just want to do real estate. Like, this is kind of fun. This is cool. You go around, you talk to people, you deposit checks. And the first instinct is, well, hold on a sec. You're going to university, right? That dad thing kicks in and it's like, no, you're going to go study. And then I said, well, hold on. He's thinking outside the box, right? And so this is cool. And so before I kind of snapped at him, I said, all right, well, tell me more. He said, well, I can kind of learn from you, and I'll just, I'll be able to work with the tenants, and, this, I can kind of learn as I go. And I thought, okay, I like that ambition. But I said, what you should probably consider is going, and maybe you don't have to take a master's degree, but you should go and learn some financial skills, or go and take some a business degree or something like that, or a diploma at least. And so I got him thinking about that. But it was very cool. His first instinct was like, no, I'm just going to go for it, and I can kind of do it that way. So I like that thinking because, growing up, I mean, your dad had his own business, but, I come from a more traditional sort of, kind of 9 to 5 kind of household where, both my parents were working and for somebody else. And so, starting a business and doing your own thing, that was not really kind of in my mindset growing up. It was just, high school, university, get a corporate job, and away you go. Whereas I think exposing kids to these types of ideas and things like that at an early age is awesome, right?
Yeah,
because it just kind of will go from there.
You've expanded, his horizons are expanded because of what he's seen, which is cool. Like that alone is so very cool to me.
Yeah. Yeah.
Yeah. If my kids came home and told me that, I've already told them, like, as long as you need a plan, like I want an understanding of, it's not just like, well, I don't think I'm going to go.
Right.
Okay. Well, what's the plan?
Plan?
Is there a real business plan in place for something you're going to be doing?
Yeah.
I think that's something my wife and I would probably disagree on. And she's kind of just said, she's like, no, they're going to, there's university, college, I don't know, whatever, some sort of post-secondary thing. Yeah. They're going, they need that.
Right.
And I'm kind of like, I don't know, there's this thing called YouTube. Yeah. Right? And you can learn a lot on it. Right? So, that'll be interesting to see when which way they head.
But that is the best though. Just seeing, and again, it goes back to this thing about time, right? like if you're able to set your kids on a path with just understanding money or business or real estate and thinking about assets, and if you could do that when they're in their teens, I mean, geez, like it's an amazing thing.
Oh, well, the time is changes everything, because if you could take all the lessons, and this is something I've tried to share with my daughter gets very competitive with me, and not I've talked to my wife about this. I'm like, I don't feel like I put this in her. She's like, no, like you haven't been like that with her. So, and I try to explain to her, I'm like, hey, like I want you to be better than me.
Right.
Like that's my goal. So like, but if you can, sometimes I'm like, hey, can you just listen sometimes?
Right,
like I've done a lot of stupid things. I've made these mistakes. So if I can share with you, I'm not trying to say this because like I'm your dad and I'm like, hey, I'm your dad. You need to listen to me. I'm like, I've done the stupid thing. I've learned the lesson. If you can now take that lesson, you get to start at whatever, 15, 20 years old, where I was at 40 years old, you're flipping 20 years ahead of me.
Right.
That's the goal. But it's when you're young, I mean, it was hard for me to listen to anyone, so that's the challenge with that, I think.
Yeah. So were you the rebellious one between you and Tom, or was he?
Yeah. I mean, Tom definitely had his share too, for sure. I mean, everyone went through their stages. My share was probably a little bit more aggressive for a little bit longer, maybe than Tom. So, maybe more extreme.
You're the younger brother.
I don't know. Yeah. Like he basically threw the blocks, the parents were worried about like, hey, what's going on with this guy? He's older.
Hey, man.
And it was like,
Number one. Yeah.
This younger kid, they're like, I don't know, let's just hope this older one survives,
If we do, good enough on the older one, he'll rub off on the younger one. Yeah.
But I grew up in a generation, like, it's so weird. I laugh within our family. I'm like, look, we're raising bubble babies, and because my parents were literally, they just didn't know anything. Like, we left the house and we kind of came back around when we were supposed to. And that was it. They had no idea what the heck was going on.
When the street lights go on, that you got to come home. That's what it was in the summers. And, and back then, if you had a bike, was freedom. If you had a bike, you were gone.
Oh, we were gone. Yeah,
just gone.
And we had, I lived on a street, like right around us. There was within about 3 years of me, there was there was about 5 or 6 of us all within, and it was just like a little gang, little gang of boys running around the neighborhood. Like, it was just a disaster. And so we were gone to doing God knows what. And some things I don't even remember. Like, it's not like we were, we weren't doing criminal activity or something, things like that. But it's just, we weren't also like, sitting talking on the front porch. That's for sure.
For sure.
So it's, it's weird. It's definitely a different time.
Yeah.
But that's cool. That's cool that they're looking at that.
Yeah.
So, how do you structure things? So you like, obviously capital intensive business for you. So you had some capital, I'm sure, to continue to grow this. Most investors then, they, the biggest thing that they do is they run out of capital and then they start working with others. And I guess you kind of went down that path too.
Yeah.
Did you go down that path right away, or how'd you kind of get rolling with it?
No, I definitely have my own capital in our deals, but the way we set up our acquisitions now is in a limited partner, general partner setup, right? So we're the general partner. We acquire, manage, handle all aspects of the real estate. And then the limited partner would be accredited investors who come on board. They're going to invest passively with us, and then basically sign on to that partnership agreement. So they're able to get the returns out of it, invest passively, and then we handle it as a general partner. So that's typically how it's structured. The general partner, us, we're going to be investing in the deal as well. But the majority of the funds, going forward is going to be from those limited partners.
Mm-hmm. Yeah. But if you don't know when the deals are going to be, how do you then communicate with? Do you just, I guess, get people on a list if they're interested, and then when a deal comes up, you kind of let people know, like, hey, there is something. If you're that, if now's the time for you or whatever.
Yeah, exactly. So we have an investor database, and basically we're having calls and in contact with people and telling about, here's a deal we did recently, and this is what it looks like, and this is, if you were to come in at this much, this is what the return would be, and so we're breaking it down and using case studies. Once a deal's live, then obviously we have real numbers to share, and we're going to send that out to people, and then actually have very specific conversations on that. Some other shops do it. Some other investment companies will set up like a fund and do it that way.
Yeah, that's what I was just going to ask. You're doing project by project.
We're doing project. It's much simpler doing it that way. There's just a lot more red tape setting up a fund and just, having an ongoing. It is a lot more versatile. I will say that. So it's something we've looked into, but right now for what we want to do, it's much more, beneficial to do it project by project. Yeah.
And then you're dealing with a lot of personnel. Like the flip side of that is there's a lot of people then asking you questions, dealing with personalities, and, then like if there's a cash call in a building, which in that space, it's less likely, but I guess if there was a major structural issue or something, there's that type of stuff to consider. It's just,
and that's why we keep the size of investors on any deal pretty tight.
Yeah.
We don't want to cast the thousands, right? Because then you're managing everything and anything. And hey, what about this? And can I come to see the property tomorrow? And can you meet me for? So, I mean, we love our investors. We want them to be successful, but we specifically keep things pretty tight, just so that one, there's enough time to dedicate to them if there are things coming up, but two, it's just a lot more.
Yeah, that makes sense.
Yeah.
Something else just came to mind. That the platform Addy, that we've them out of the events. So now we know, on a smaller scale, people that have used Addy to raise capital, and then on a decent sized scale too, like Mike and Luke, who are some developers they have some properties in the Scarborough area. They just finished, they just closed on most of the units. They did a mid-rise condo, and I forget what project they use Addy for, but they just recently launched a project on Addy, and they were doing some capital raising that way. And I'm just wondering how, could that play into something here? That is,
so we've actually been talking to Addy about.
Oh, have you? I didn't realize.
No. So we've been talking to Addy since for probably about 3 months now. So it's something we're looking into because crowdfunding. Why not? If people want to invest $100 or $1,000 and there's a platform like Addy to aggregate those, then that's something that we're looking at.
Yeah,
right? Yeah.
Because at that level too, then people aren't like, hey, where's my money? Because it's $500. It's not like this life-changing money for them, right? So like. That's kind of cool. That would be cool to see too. Yeah. But
so we definitely been talking with those guys. So typically, the way they're working is they're doing the crowdfunding, obviously, and then they're working with what's called an exempt market dealer, who's actually got all the regulatory framework to
for the offering. That's
the offering memorandum. So those two kind of go hand in hand. So yeah.
I forgot about that whole side. The whole legal side. I just kind of blocked that out. Legal paperwork. I just kind of blocked that stuff out. Oh my gosh! I remember years ago, someone off some Bay Street lawyer came to us. They're like, "Hey, we want to start a fund. We want to do this with you guys. We want to do this," and we just kind of took a glance at like. Just all the regulatory stuff. And we're just like, we're just not interested, especially at that time. Like we were still really kind of focused on growing. It wasn't, and I was just like, this is just not a path I want to go down. It's just so messy, right?
Yeah. I mean, I think from people that I've talked to that have gone through it, once you get through all those hurdles and do it, then it is a great thing. It's very versatile to have that. But again, it's got to fit with your strategy and what you're doing, right?
How do the and then what's the exit strategy for these things? Like as an investor, so if someone invests in one of these projects, they're long term. I guess they're getting some sort of dividends spitting out from the income of the property. And what's the exit strategy? Like, is there one?
Yeah. So the deal will be underwritten based, whatever it is, right? So if it's, sometimes it's shorter term deal, it's maybe 3 years in and out, but that's not typically what we're doing. We're looking at 5 years plus. Just to kind of coincide with the lease structure and the way that we want to be managing these properties. So again, because it's project specific, all those investors will be earning those dividends along the way, and then they'll be cashed out and then receive their proceeds based on the sale of the property at that time.
So buy a property, get it leased up, try to maximize rents, sell it for value at that time, whenever that time is. Once there,
right. And again, this is not like flipping where we're going to be in and out in 6 months or a year. So it's longer term, so people can kind of say, if I invest in this and here's the equity multiple, here's the expected return, and then it's going to be 5 years. Which I think
you mean you're not going to become a multimillionaire in like 30 days without doing anything? I didn't know. I thought that's what you were offering. Why did we have this conversation?
Yeah, exactly.
Get out of here.
Didn't you hear? What is it? Real estate's get rich slow. That's what it is.
Yeah.
Right?
Oh, man. I can't tell you the number of people like, the last few years on our side of things has been, I mean, look, it's been great on the business and stuff like that, but it's just so many people were coming to us. We're like, yeah, I just want to buy property. It's real estate. Like it never goes down. It's this. And we're like, guys, slow down. Like this is like the most abnormal time.
Yeah. But I think it speaks to, just an example like that. It speaks to the fact that people really need to come up with a strategy for how they want to invest, right? So if someone says, I want to get into real estate. Okay, well, do you want cash flow? Do you want appreciation?
Exactly.
How quickly do you need your money out?
What kind of lifestyle do you want as the real estate investor?
Yeah.
How much of your time and energy do you want on that?
Exactly.
Do you want to be completely hands off and take a little bit less return, or do you want it?
Exactly. Yeah. So again, active versus passive. And I think it's important to understand that, because a lot of people, especially that I talk to, will come in and say, "Oh, hey, I got $100,000. What do I do with it?" And it's like, whoa, just hold on. That's great. You've got some money to invest, but let's kind of map it out, because the notion sometimes is, I'm just going to go buy a property, and how hard could it be? And let's figure it out and roll up our 100%. Sleeves. And, we've both done that, and we've been weekend warriors and kind of, renovating duplexes and stuff like that back in the day. And I think it's good to learn that, but if that's not going to support what your strategy is, then there's lots of options out there, right? So, we offer passive invested, but if that's not for you because of your strategy, then there's lots of active ways to earn money as well. So mapping that strategy out, and again, mapping it back to your goals and where you want to be in 5 to 10 years is super important.
Yeah, 100%. And there's stages, right? Like when I was in my early 20s, when I started investing, I was putting all the sweat equity myself. Mm-hmm. Because to me, I had more time than I did money. So it was like, that's how I was kind of offsetting it.
Yeah.
But then as you have more responsibilities and family, like at this stage for me, do I want to be going down to the property, to some sort of property and doing the work myself every weekend? Well, no, my kids have riding lessons I want to be at and cheer, there's other commitments and, and my week's a lot busier now than it was during that 9-to-5 job then. So I would rather than use money to then kind of offset and buy back my time to be able to do other things. There's it's just, there's no one way. And there's, it doesn't mean that I wouldn't do it. Mm-hmm. I don't know under what circumstances I would. I'm trying to think about it, but it doesn't mean I wouldn't do it again. But I just mean, it's not that I'll never do it, but it's just the circumstances have to be right. So it's just, there's never like one best way.
Yeah.
That's what I find everyone wants. They want like, hey, what's the best way?
Yeah.
What's the best, easiest, fastest thing that's going to give me the biggest return?
The most optimal structure. I just want it right now.
Yeah.
And then, 48 hours later, boom, it's all done, right?
I want it right now too, by the way. Hey, if you find out what the best way is, let me know.
We'll talk. We'll talk. Yeah.
Hey, for anyone looking to reach out to you, so if someone, I guess people to reach out to you for, I don't know, what do you want to reach out to you for? Obviously, if they're interested in one of these projects or more details on one of the upcoming ones you might have, do you have a website to you? Is there an email? Like, what's the best way?
For sure. So I invite everyone to check out our website, focuscapital.ca. On there, they can see the projects that we've done. They can find out more about our strategy, where we invest. There's some free guides there to investing in industrial real estate. There's some podcast episodes that I've done previously. So there's a lot of free information on there that people can kind of get.
You don't need any other podcast. Once you've done our podcast, there's no need for any other podcast episodes. No, I'm just joking.
I'll just delete them all and just put.
See, now we're talking. Appreciate it. No, that's cool, man. It's. We spoke before as you were thinking about doing this,
mm-hmm. A few years back.
Yeah. And it's really, it's cool and it's impressive to see what you've done, because a lot of people will look at this space and it can be intimidating because the numbers are big. It's not overly, like anything in real estate investing, it's not rocket science. You know what I mean? If you're going to put the time in to learn and understand it, I'd imagine your engineering background has probably come in really big handy for what you've done.
Yeah, I think on a couple fronts, like I said, just having that analytical side helps, but also because a good chunk of my my corporate experience was in commercial real estate, managing big construction projects and things like that. I was not worried about getting into these types of assets, right?
I think I forgot. So I forgot about that aspect of it. Yeah.
So for me, there was a familiarity there with it that I could just kind of walk into it and, had steel toe boots in my trunk that I could use to get into warehouses and stuff. And so there was that kind of ease about it.
But still, I think it would have been very easy for you to kind of check it out and then maybe revert back to something being like, hey, maybe I'll just throw a couple resumes. It looks like there's a good opportunity in this position here. Maybe I'll just jump on that one. You know what I mean? So for you to kind of continue down this path and to chug along and do what you've done and build it to this point and kind of keep moving, it's impressive. I don't think a lot of people would have been able to even get to this point. And you deserve all the credit in the world for that. It's not easy, especially when you're going out on your own, and you got other responsibilities, you got the family at home and stuff. So it's really cool to see. Like, it's congratulations on everything you've got so far.
Appreciate that.
It's really cool.
Yeah, I appreciate that.
And then thanks for coming in. Thanks for coming in and sharing this.
Thank you.
What else are we missing? Anything else to share?
That's it. Again, invite people to check out our website, focuscapital.ca, and
Cool. Thanks, Stephen.
Okay. Thank you, Nick.
Hey, thanks for tuning in. You can find every new episode of the Your Life, Your Term show on all the major streaming platforms. So Spotify, iTunes, Google Play. And if you'd like to get free copies of some of the books that we've put together, like these right here, or some of the reports that we've put together, like these right here, you can find all of those at www.rockstarinnercircle.com. That's www.rockstarinnercircle.com. That's it for now. Until next time, your life, your terms.